So we do this series every month on the channel, and this month I want to do it a little bit differently. I actually want to jump in front of the computer this time to share my information that I found more easily with you guys, to articulate why I believe these three stocks are actually really great buys today. And I think it's going to help me provide, much more value, much more insight in these type of videos. So I hope you guys enjoy it. Now, full disclosure, I own 2 out of 3 of these stocks. So take your guesses. Let me know in the comments down below which stocks you think I personally own. And while you're down there, hit the like button, share this with a friend, subscribe to the channel, and let's jump into it. So the first stock of the bunch here in this video is Spotify. Not to be mistaken with Shopify. Spotify, the popular music streaming service. This is a stock that has kind of gotten onto my radar recently, and I've been extremely interested with all of its financials, its fundamentals, and kind of the future prospects of this business here. So right now, today, the stock is sitting 30 some odd percent off of its highs, and I think at a 50-ish billion dollar market cap, which is kind of where it's at today, this one is cheap. I think this one has a lot of runway to grow. I think this one has massive potential ahead of it because it's pretty much going after the global market for music and streaming. So I think there's just so much more for Spotify in the future here. Now, when I go to like the shareholders letter, for example, this is a company that I see growing massively. They have a couple segments to their business, right? They have their premium subscribers, and then they have the ad-supported subscribers. Obviously, the ad-supported subscribers are not as loyal, if you'd say that, because of course they're there to enjoy some music, but their real income for Spotify for this is through ads. The real bread and butter is through the premium subscribers. These are the subscribers like myself who are paying a monthly fee to access Spotify's platform, to access their library of music and podcasts and possibly even some sort of video type thing in the future. And that's really where this business makes a ton of their money. You can see here how things are broken down, right? Things are growing fairly well year over year for both premium and ad supported. The idea, of course, is to get people on the ad supported for free, try it out, and then they love it so much that they switch over to premium. That model's been working really well for them so far. The business is also growing rapidly on many different segments. You can see here's the monthly active users by region. So this is not just a company that's just in the US or North America. They are big all over the world, and they just keep growing all over the world, which is why I love the opportunity here. Europe, 35% monthly active. North America, 24%. Latin America, 22%. Rest of the world, 19%. And over time, as the rest of the world, like Asia, for example, and Africa, once things get more stable there in terms of infrastructure and internet and 5G and that kind of stuff, expect this piece of the pie to be one of the more dominant pieces here. Right now, we can see Europe is huge because Spotify, if you weren't familiar, is a European company. But also here in North America, almost everyone has access to Spotify. A lot of people use this on a daily basis for music or podcasts, and I think that's just going to keep growing the subscriber base and their loyalty with their customers over time. And now there's a lot more to read if you go through their shareholder letter here with Spotify, but I'm not going to do that in this video. I'll probably actually do a dedicated Spotify video at some point. But just understand that this company is growing and growing nicely. So as of today, guys, here's Yahoo Finance. This company is at a just over $50 billion, almost $52 billion market cap. And if we look at what analysts have projected for this business, they see that this company is going to be growing around 19% this year, another 19% next year. A very, very strong growth ahead, close to that 20% that I look for with my stocks. I think that they'll actually be able to surpass this. Probably hit like 11.5 billion or so this year, probably hit 13.5 next year, maybe a bit more than that. I think this company is being underestimated by Wall Street, and I think that's why I really like what I see here. Now, you may be saying, Nick, this is a company that loses money. Why would you want to invest in this company? And yeah, that's true. They do have negative net income currently. However, the real key here is their free cash flow, guys. The free cash flow is very consistent. It's growing nicely, expected to grow astronomically in coming years. And I think this is really where investors are going to recognize the company is a profit machine over time and start buying heavy into this. I want to share with you my modeling, a little bit of that for Spotify here when it comes to kind of the revenue projections for this business. You can see here that, I did a $48 billion market cap estimate the last time I updated this. We can update this now to a 52 billion here, which is what it's at today roughly. And we can see, okay, so if I buy this company today with revenue estimates growing around 25% this year, which I think is definitely doable, this company should hit around, $11.24 billion and a price of sales of 4.6. If I stretch it out 1 year for end of 2022, I'm paying a 3.88 price of sales with a projected growth rate of only around 19%. So this is fairly conservative in my opinion. I think, like I said, they'll be able to smash these numbers. But, worst case scenario, I'm paying around a 4 to a 5, let's say, for price to sales. Now, if I look historically at Spotify here, I can actually do this on TradingView itself. We scroll down here, we can see that historically, this business has a price of sales on average, in good times, I would say, of around a 4. Let's say like a high 3s, 4. In recent months, it's been around, the 5, 6, 7 range, which I think is a little bit expensive. Now it's come down to under 5.5. But on average, around a 4 is what seems to be reasonable here for Spotify. And if I look at the model again, I'm getting around a 4-ish for the end of this year. So I'm paying, in other words, around 1 year out for Spotify if I buy the stock today to make the valuation somewhat reasonable for me. Now, in terms of the actual charts for Spotify here, guys, I think this one is extremely oversold, down 35% at its lows. If we look at the weekly here, we can see the stock is trying to find some support here at the 50 moving average on the weekly. We didn't come down to this orange line, which I was kind of hoping we would, but we came close. We didn't quite get there. And it looks like it's sort of forming a base here, a bottom, if you will. And I think you'll probably see a nice rally in the stock in coming months here, because many people see this as, hey, maybe it's a stay-at-home stock. But guys, you want to listen to music wherever you are. You're at home, you're out, you're at the gym, you're at the park, you're at a friend's house. You want to listen to music. And Spotify, in my opinion, is that company to get things done. Now, I know there's a lot of talk about competitors and, Apple Music eating their lunch and all this stuff. And like I said, I'll save that for a dedicated Spotify video. I have pretty good rebuttals, in my opinion, for that. So I'm not going to really go through that in this video, but I just want to cover this. Spotify is the first stock for this video. Our second company is probably one you guys have used their products before. Not the most exciting, but it is Clorox. Clorox is definitely a, simple business to understand. They're here to help us with, disinfection and cleaning and that kind of stuff. It, of course, helps with what we went through last year and what we're still going through this year. So definitely a company that, is kind of critical to society, in my opinion. Whether, we get past all of this here that's been going on, whether we're in just regular times, we still use their products regularly. And I think now more than ever, things like disinfectant wipes, that kind of stuff, are going to become the norm going forward. Clorox did have a phenomenal year last year. And right now the company sits at around a $24 billion market cap, okay? So it's not a huge business. It's not, one of those massive Procter & Gamble, Johnson & Johnson type businesses. But it has that sort of reputation, in my opinion, that sort of prestige, in my opinion. So you're getting a good company here at a pretty reasonable price at around $24 billion. Now, analysts, they're okay here. They're seeing this company grow this year around 12%, $7.5 billion. But they expect next year to be relatively flat. Is that going to happen? I don't think so, guys. I think that if anything, spending for their products is probably going to pick up over time, like I said, and that's going to result, in my opinion, of some nice growth next year as well. The stock market right now is underpricing this. Analysts on Wall Street are underpricing this, and it's an opportunity really for us to come in, take advantage, and benefit from a nice recovery. This company, of course, is extremely profitable. They're earning hand over fist here with everything going on. If we look at their consistency here, this company has just been steadily chugging along, a profitable business, almost $1 billion a year in profit. And again, it's something that's kind of an essential in society. You can see everything just looks really strong for this company. It did kind of run up here with its price to sales in recent months, thanks to everything in 2020. But now we're back to levels that we were back in 2019. So you're buying this stock here with a good future ahead of it, a very stable company. It adds a ton of stability to your portfolio and diversifies you out of tech. And you're getting it at a fairly reasonable valuation. And if you look at their price to free cash flow, you're getting it at, a bargain, if you will, here. Another good thing about this business is that they consistently buy back their shares. So every year, your shares are valued more as they take them off the market. It's not a company that keeps diluting shareholders, a little bit here and there, but overall the trend is down. And guys, the real kicker here for this is that they give you a nice dividend. They're currently paying a 2.3% dividend. They have a 50% payout ratio, which is very sustainable. They grow this dividend by 7.5% year over year. And they've been paying a dividend for 19 years. So they're getting very close to aristocrat status. And I think this company is just going to be one of those companies that, you wish you bought a long, long time ago, just because it's so consistent, so safe, so stable that you just want it part of your portfolio. If you look at my dividend yield history here, this will really tell you that, hey, right now, it's a little bit more expensive than what it is historically with around a 2.4% yield. But guys, anything around 2.5% or so, it's a bargain for this business. So that's our second stock today, guys. Moving on to our third, Teladoc. This one is definitely one that got a huge boost because of last year. And unlike Clorox, which we'll just see consistency now going forward, this one's actually going to see massive growth going forward because it's pretty much pulled forward a lot of expectations many, many years in advance. So things were shifting towards a more telehealth kind of a world. Probably by the end of this decade, we were expecting to be fairly good with that. But now because of 2020, it's pretty much a norm today. And this is just going to keep growing over time. This has definitely been a company that I've been watching very, very closely. I know ARK Invest is a huge fan of this. It's one of their largest positions actually in their portfolio. And after the recent dip, this stock has caught my attention. So if we go here and we look at Teladoc, we can see that this stock has come down pretty close to a very key support level on the weekly. It's come down to the 100 moving average. It looks like a double bottom almost here. And this signifies around a 46% correction from its highs. The stock is extremely oversold. It's showing me value and it's telling me, hey, if you want to buy into this company, this is probably the time. We can see here in the past, it's had quite a few levels where it's tested this orange line. We're pretty much there again. We may come a little below that to test it properly, but this could be the bottom, guys. This could be where the stock reverses and starts shooting much, much higher. This is another company that I want to do a dedicated video on. I probably will at some point. Let me know in the comments if you want to see that, because I think there's a lot of interest around this, and I think because of its future, it's a company that we should not be ignoring. Now, if we look at what analysts have to say about Teladoc, you can see first off, the company size is around $28 billion. Not a huge company, and with health becoming so important, health becoming kind of front and center for the future, this should be $100 billion plus at some point in the future. I have no doubt about that. We'll look at what analysts have to say here with this on Yahoo Finance. They expect this company to grow 81% this year and 31% next year. Absolutely astronomical growth. No signs of really, becoming a slow growth business. This one is like almost in hyper growth mode, and I really like what I see here. I'm also going to share with you my modeling here with Teladoc, because I think this company is also worth spending some time looking into. Now, historically, this company has been around a 13 price to sales. This is kind of what I've calculated, and with a market cap around $26 billion, which is what it was at, just a couple of days ago. This company was pretty much at what its historical price to sales was, around a 13. This means if I'm buying the stock today, I'm paying essentially for this year's earnings, and then everything after that is gravy. Next year looks like a 10, 8, 6, 5, and it just keeps reducing significantly year over year, as you can see on this graph. So I'm getting some good value from looking at price to sales for this company. I'm getting a real bargain here for a high growth company, and I've been pretty conservative. So over the next few years, I've pretty much modeled out what analysts are expecting. But then 2023 onwards, I've just said, okay, let's say it grows by 25%. This, of course, is conservative for a company growing this quick. I think this can probably do 30% plus for the next few years, and that'll pull down the valuation even further and make this an even more attractive business. Now, with Teladoc, there are a couple of red flags that you do need to know if you're looking at this business. It's not a profitable company today. It's losing quite a bit of money, actually, but it's growing at a rapid pace. They had a merger with another business recently, which is what's contributing to a lot of the losses right now. And if we just jump over to their balance sheet here and their financials, the one thing I want to point out was their goodwill. Because of the acquisition that they made, their goodwill shot up massively. So typically this would be around, it was growing here at 1.6, 2.4, 3.4 in total assets versus around, 1.5 or so in liabilities. But now because of this massive goodwill spike, things are a little bit skewed. You are paying, for a business that has a decent amount of cash on there, a decent amount of assets if you take out the goodwill, but that is definitely still a risk to consider because they do have a good amount of long-term debt on their balance sheet. So guys, those were the 3 stocks for April. Again, let me know which 2 out of 3 of these you think I personally own myself. I'm gonna read every single comment down there, so I truly do appreciate you taking the time to let me know. But either way, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.